Space Exploration Technologies Corporation, Class A common stock, trading under the ticker symbol SPXC, is currently sitting at $131.66 per share, marking a noticeable intraday decline of 2.66% as live market trading continues. This downward movement pushes the price action below the psychological milestone that many early market participants viewed as a firm floor, adding a fresh layer of tension to an equity that has captured the attention of individual brokerage clients and institutional desks alike. While the mainstream headline points to a routine technical pullback or the short-term postponement of a massive Starship launch vehicle test, the real story here runs much deeper. The market is experiencing a profound structural realignment regarding how it prices the asset, especially after the company integrated significant artificial intelligence assets, the massive data infrastructure of the Colossus data center, and the global communication network of X. This is no longer just an aerospace play dependent on government launch contracts. It is transformed into a sprawling, vertically integrated industrial behemoth trying to balance capital-intensive rocket engineering with high-margin digital applications. The immediate insight that standard retail accounts miss is that the current sell-off is less about structural failure and more about liquidity clearing out speculative participants who expected an immediate, unhindered upward trajectory right out of the gate. When you look at the broader expectations surrounding Space Exploration Technologies Corporation, the prevailing narrative across retail trading platforms and social media forums suggests that this asset should behave with the same explosive upward momentum seen in previous high-growth cycles. Investors look at how NVIDIA stock has captured structural market value over the years and expect this asset to mirror that exact path, assuming that global dominance in low Earth orbit automatically equates to an unassailable financial premium. The widespread belief is that because the core commercial launch business operates with an efficiency that leaves traditional defense contractors far behind, the equity deserves a premium that surpasses standard valuation models. However, the cold reality of the market is asserting itself through recent daily swings and elevated trading volumes. The market narrative is clashing directly with a very clear reality. Building space infrastructure requires an enormous, unrelenting amount of capital expenditure, and the recent acquisition of artificial intelligence units has injected a high level of operational complexity that traditional analysts are still struggling to model accurately. This tension between what the public expects a modern space empire to be worth and the hard numbers found on balance sheets is what is driving the current volatility. If we break down the immediate technical data from the active trading session, the trading volume has shown distinct spikes on downward legs, suggesting that institutional players might be resetting their risk parameters rather than aggressively buying the dip. This activity is generating significant conversations across major investing sites where self-investing participants discuss whether to accumulate fractional shares or sit on their hands. When an asset like this breaks below its early benchmark pricing, it triggers automated stop-loss orders across automated management systems like Schwab Intelligent Portfolios and other algorithmic active investing setups. This creates a cascading effect that feeds the intraday decline, even if the long-term fundamentals of the underlying business remain unchanged. Sector momentum across the broader aerospace and defense space has been relatively stable, which highlights the fact that this specific correction is idiosyncratic to SPXC rather than a systemic withdrawal from the industrial sector. The recent reaction to internal product timelines shows how sensitive the equity has become to operational updates. Even minor adjustments to test schedules now result in multi-percentage point swings in the open market. Macroeconomic pressures are also playing a substantial role in shaping the immediate trajectory of the stock. With global interest rates remaining a critical variable for capital allocation, growth assets that defer major cash generation into the next decade are facing intense scrutiny from asset managers managing traditional wealth funds. An individual brokerage account focusing on near-term cash flow might find the current multiples hard to justify when compared to traditional defense equities that offer consistent buybacks and dividends. Institutional positioning reports reveal a widening delta between long-term venture-style growth funds, which are comfortable holding the asset through multiple years of heavy infrastructure builds, and tactical traders who are using option income strategies to extract yield from the massive implied volatility. The recent launch of dedicated single-stock options products targeted at this equity shows that Wall Street is eager to financialize the intense public interest in the stock, providing tools for sophisticated hedging but also increasing the potential for sharp, gamma-driven intraday swings. Comment below how many shares of Space Exploration Technologies Corporation you currently hold in your portfolio, and let me know if you are actively buying this dip or waiting for a deeper correction. To truly understand why the current market reality is testing investor patience, it helps to examine what this corporate entity actually does day to day. Founded in the early 2000s with the specific objective of lowering the cost to reach orbit, the corporation systematically dismantled the traditional aerospace cost structure by focusing on vertical integration and regular vehicle reusability. The core operational framework relies on the Falcon 9 and Falcon Heavy launch vehicles, which have become the workhorses for global satellite deployment, civilian cargo logistics, and crew transport to the International Space Station. This established segment generates predictable revenues from stable government entities like NASA and the United States Space Force, alongside private satellite operators who require reliable manifest placement. Alongside this, the connectivity division has built out the Starlink constellation, which positions thousands of small satellites in low Earth orbit to deliver consumer and commercial wireless internet services across dozens of international jurisdictions. More recently, the corporate footprint expanded dramatically through the absorption of advanced computing units and the infrastructure behind X, creating a dual-threat asset that attempts to merge physical logistics with high-level data processing. Looking back at past performance indicators and older reports, the enterprise has historically scaled its private valuation by demonstrating massive technical leaps that external observers previously deemed impossible. Milestones such as the routine vertical landing of orbital rocket boosters and the successful deployment of a global satellite constellation provided the foundational justification for its multi-billion-dollar private funding rounds. However, the transition to a more widely tracked asset class introduces a different level of accountability. When operating as a closely held private entity, the long multi-year development cycles of projects like the massive Starship system could be masked by private capital injections that did not require daily mark-to-market pricing. Now, every delay, every test anomaly, and every regulatory hurdle is immediately reflected in the public equity value, forcing a confrontation between the long horizons of aerospace engineering and the short horizons of modern public markets. This brings us back to the crucial framework of expectation versus reality as we look toward the future outlook of the company. The public expectation is that the upcoming flight tests of the fully reusable Starship system will seamlessly unlock a massive new commercial economy, instantly multiplying the tonnage that can be lifted into space and dramatically dropping the per-kilogram cost of orbit access. The market expects this vehicle to quickly achieve the same operational rhythm as the older Falcon 9 fleet. However, the reality is that deep space hardware engineering is non-linear, filled with unpredictable hardware constraints, metallurgical challenges, and complex regulatory oversight from federal flight authorities.
If the corporation encounters extended delays in proving the total thermal protection or the precise orbital refueling capabilities of the vehicle, the capital burn rate will remain elevated longer than the consensus models assume, forcing the stock to consolidate or drift lower as speculative capital loses patience. On the alternative side, the upside catalysts are equally distinct and powerful. Should the upcoming flight schedules proceed without significant incident, demonstrating complete vehicle reuse and reliable payload deployment, the reality will decisively outpace the cautious expectations of the market bears. Such a breakthrough would widen the competitive moat against international state-backed programs and legacy domestic competitors, securing a functional monopoly over heavy lift logistics for the next generation. Furthermore, the rapid expansion of the next-generation Starlink constellation presents an opportunistic avenue for significant high-margin subscription revenue, which could provide the necessary internal funding to insulate the broader corporation from external macroeconomic shifting. Investors using a self-investing approach through an individual brokerage or exploring specialized options in a Fidelity ETFs